Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, May 21st, 2020. We're looking at a mixed market today. When I woke up, futures were lower than, sort of by the time we opened. Of course, they were higher because buy the dip seems to be the trade that's working yet again. Although we are starting to see them, at least at this time, selling off a little bit, but really not in a meaningful way, just a little bit of profit taking. We are going to be facing a 3-day holiday weekend in the U.S. It's going to be interesting to see how that affects trading patterns. Normally you can see some strange things happen ahead of a 3-day weekend because trading volumes tend to evaporate as people go away for the long weekend. Living in Connecticut, as I do, Thursday night before a long weekend is usually one of the worst days to be on the road because people try to get out a day early, extend the long weekend. That's, I guess, fairly normal behavior ahead of a major U.S. holiday. I don't know what's going to happen this time. I don't know who's going anywhere right now. States are starting to reopen, which is good, at least for the economy, if not for everybody's health. We'll see how that plays out over time. But as of now, it's encouraging for the economy that people are going to have a little bit of spring fever and get moving. But I don't know what that means for trading. Right now, we're flirting with the high end of a trading range that we've been in for the better part of a month. Pretty much since early to mid-April, we've been sort of in this, and I'm going to use S&P terms, 2,800, 2,950 trading range. A little bit higher than that, I guess, 2,970 or so would be the high end. It would seem to me that the market has a lot of work to do to get through the 3,000 level on S&P. It would essentially mean we've recouped almost everything, and that in hindsight we would have had a small garden variety correction, when in fact that's really not what's playing out. It would also mean that we'd have to basically cross through a big round number, which markets usually find some resistance around, and the 200-day moving average, which markets find resistance around. But if we get some holiday lightened volumes, anything can happen. It's one of these trades where my gut says we're at the high end of the trading range, but the other part of me is saying, gosh, I would probably hedge some of that upside just in case, because you never know what happens. And so it's a really tough environment right now. If you want to go on the valuation front, of course we're stretched. We all know that. Right now, everybody's more concerned with don't fight the Fed than with actual valuation numbers. One of the rationales that I hear is that you can increase the PEs that you're willing to pay because interest rates are so low and you're discounting by a very low number. The counter argument to that is Japan, Europe, where they've had incredibly low rates for much longer than we have. And they really haven't had any sort of the multiple expansion that would be justified by an accommodative central bank, because they've had accommodative, particularly in Japan, you've had an accommodative central bank and virtually zero interest rates for the better part of 2 to 3 decades, and it really hasn't done very much. I don't want to go down the road and say that we're in the U.S. we're looking at a Japanese valuation paradigm, but I do have to wonder where the support comes in. When people say, we can support really high PEs because if you discount the future cash flows by this really low number, okay, that's wonderful. But ultimately, if you have those really low rates for a long period of time, are you going to get the cash flows that you're expecting? They probably both can't happen. But in the short term, market doesn't care. And until we see that it does, it's a very tough trend to fight. Don't fight the tape, don't fight the Fed. Remember, the codicil to those things are, if you don't feel comfortable, you don't have to play along. So I guess if you're a professional who has to be fully invested, well, that may be the case. But for the most part, if you're an average investor and you don't feel comfortable, don't fight the Fed, don't fight the tape, but you don't have to join in. Anyway, we will talk soon, and get ready for the long weekend if you are going someplace. Take care. Bye-bye.